Hi, this is Shane with The Rational Trader. It is Tuesday the 29th, and this is a daily chart of the NASDAQ. And one of the things we've been struggling with is these huge spikes in volatility, just really unprecedented in my trading career. And the aftermath of that and how to deal with it. And it really took me, 4 to 6 weeks at least to figure out sort of what to do with the machine learning system and how it interacts with the volatility. And now we have this sort of new dynamic where the market is settling back down, and this red line here is my guess at where is the dividing line between building a model that is for volatile conditions versus building one that's for normal conditions. And it's truly a guess because we've never seen this before, and machine learning is new. And you can see what I did is as I just went back in time and kind of found the spot where it looked normal, and it's around round number of 100. This is the average daily range with, I think it's a 10-day period. And so as we came into last week, we fell below that level, and so I built a model last week for in normal conditions, and ended up getting nicked a lot last week. So it was just miserable trading for me last week. I lost money every day, and a bunch of those times were the cases where you get nicked by just a tick or two. And under normal times, when we're at these kinds of times, and we see an uptick in volatility, our normal response is, okay, well, you double your stops and cut your size in half, and that's how you deal with that. And that certainly would have worked last week. The problem is our initial response to this volatility was, double your stops and cut your size in half. You just get killed because it's so volatile that even doubling your stops is not enough. And so anyway, last week I had built a model for normal times and then just got nicked a lot, and I just can't tell. Should I just do what we would normally do, which is double your stops and cut your size in half, or should I just be building a model that's intended for volatile times? And my decision was to build one for volatility, and that proved to be somewhat prescient, because we came in today and the overnight range was 100 points, which is so high that you have the choices to trade or not to trade. All right. Our basic rules are if you're less than 40 points, just normal trading. Start at 635 and trade like normal. If the overnight range is between 40 and 60, start later. Start at 645. Give the market at least that 15 minutes to settle down. And if you're between 60 and 100, then start at 705. Give the market a full 30 minutes to settle down. And if you're over 100, it's a coin flip whether or not you're going to get just whacked or you can do well. So trade, you could just choose don't trade. So today was right on the dividing line. It was just at 100 points. Where are we here? This is at the end of the day. And so when we came in, we were the Globex low is down here at 68.95, and the high is up at 69.95. Exactly 100 points. And so I started at 705 today. The market was very active. This is a good example of the kind of thing you see when the market's really volatile. That's a 26-point drop in a minute or two. Not even. That's a few seconds. 634 to 03 to 634.41, so less than 40 seconds. This is the kind of thing that will just destroy you if you're not disciplined in how you approach the market. If you don't have your stops in place, or you let your emotion get the better of you. One of the reasons we use machine learning is that we can remove that completely from the equation Just have a set of rules we follow at the beginning of the day, and then end of day, end of week, you're managing your risk, right? So the machine learning system is implementing your risk parameters. This amount plus one more trade is what I'm willing to lose in a day, and the system just stops. There's no question that's going to happen. So those of you that struggle to try to make up for losses and then end up losing even more are good candidates for something that removes you out of the decision-making loop. All right. So what I saw today was, so I didn't start until 7:05, right in here somewhere. Lots of nice moves in here. I don't have, because I didn't have the machine running. I don't have the codes. This kind of stuff is right here is the stuff that I've seen the machine struggle with. You have this really sharp, quick move, and then you'll get chopped to pieces in there. And then if you're following your risk rules like you're supposed to, you often you're done for the day, right? So that's why we start later, let the market settle down. So I started getting codes here. This is I can't even see what that 274. That's in the too aggressive to trade. That's a aggressive pullback short. You can see actually it's right at the end of that little move right there. There is a 287. This is also in the category of too aggressive, though it would in this case it would scratch. 286 I got short right here on that's a beautiful signal. What I've been looking for is a live instance of this automated adding that I've implemented. That's what you see in this column now. We have this extra parameters now that define how far away do you have to be before you'll add automatically, what's the maximum number of contracts that you'll carry, and then what are the different behaviors that you'll add on. And this is a beautiful entry. Unfortunately, there's no case here where we add because we don't, the break is too close. We'll add on a break, but it has to be 30 ticks away, and that's too close yet. We'll add on a pullback, but we don't actually get enough of a pullback. There's no completed wave there. There's a couple other cases. Neither of them show up in this instance, so just a quick 20-point drop for $400. And then we go into that same chop that I'm worried about, that I just talked about. We get this quick drop, the market thrashes sideways, and one of the things to notice here is that with the model built for more volatile times, you don't see a zillion codes in here. Instead, it's more selective, and in fact, 185 is a long right there. 251 is actually a beautiful short right there. The entry would be right there, but we're not taking it now because at this point the lagging indicator that we're using to say, hey, the market sideways has kicked in. I do end up taking a short here. This is the one that's just immensely painful, and it happened to me last week 3 times. We short right there, okay, and we get stopped out to the tick right there just before this fall. Now this is the fall I'm looking for, the move I'm looking for to live test my auto ad, and I end up missing it just because of that nick. That's a function of the markets are just more volatile now. So if you want to trade with a 10-tick stop, you got to live with this kind of outcome. Where would we have added? Let's see. We could run it in replay with a slightly bigger stop and see. But what I can tell you is it's going to add. It's not going to add on the break. That's too close here. All right. But once you get down to this pullback, you're going to add right there or there, one of those two places, or on that break. And then the target will reset further out, and you'll end up making 80 ticks on 2 contracts. So that's the kind of thing we're looking for. It didn't quite work out for me today. My result was plus 350 after an ugly week last week. So you got to make sure that you're following the risk management rules. All right? Just because we're using machine learning, that's using some sophisticated algorithms for pattern matching does not mean that we are magical. All right, it means that we can use the machine to remove the human from the decision. So my rules are, with the machine learning system, I'll take 3 losses in a day, and if that happens to me 3 times in a week, I'm done for the week. Those rules used to be, when I'm as a discretionary trader, they were 2 losses in a day and 2 days, and then I would stop for the week. And the reason for that is that as a discretionary trader, once you start taking losses like that, it becomes very difficult to tell if you're actually still objectively assessing the market. So I was much stricter then. That's no longer a component since I'm doing automated machine learning. And so I've opened it up a bit. I also did some analysis to see, the machine learning system takes more trades than I take, so you kind of need to give it more room to work. You need to let it take more trades before you cut it off. And the same thing with the days per week what the analysis showed is that it wasn't that unusual to see a couple days in a row where you get whacked, and then the next day you're fine, since the machine is applying the same method to every single bar. There's no question that there's emotion in the decision, so that's no longer a factor, right? And then it just becomes a function of, okay, given the bulk of data I've got now, what does it show for you to do? All right. When people hear, just one last comment here, and I'll end. When people hear about machine learning and artificial intelligence, they get stars in their eyes, thinking that means they're never going to take a loss, and that's simply not the case. One way to think about it is like this. All right, let's draw a line here that represents a spectrum. Well, actually, we'll draw 2 lines here. Okay. On the left here, this line, this edge, this is total randomness, roll of the dice. Okay. On the right here, this is completely deterministic. 2 + 2 = 4. Okay. The question that you have to ask yourself is, where do you think trading is on this spectrum? Do you think it's a complete roll of the dice? If you do, you shouldn't be trading, by the way. You should just go to Vegas. At least there the drinks are free. Or do you think it's here, where it's completely deterministic? Okay. If you're either side is wrong. All right. There's a large element of randomness in the market, and where it is difficult to assess objectively. And it moves around, all right, with the volatility. So as things get more volatile, there's more randomness in the environment. As they settle down, it's more predictable. Okay, and so what we see when the markets get really volatile, the amount of randomness is shifting left. It's shifting towards the roll of the dice. And so think about that for a moment. What does that mean? If this line here on the left, this now pink line, represents randomness, complete randomness, the roll of the dice, you would not expect anything to be able to predict that outcome. Nothing. It doesn't matter how super fancy the computer is that's doing the work, right? It's random. That's the definition of randomness. Okay, and so one of the things that we struggle with as humans is that the world exists in between these two extremes. All right, the real world, and trading is in between these two extremes. And so even if it's dead center, all right, one way to think about that is, okay, well, half the time what looks like it should work is not going to work the way I think it should. I'm going to get some random outcome. All right. And with the volatility, we move more and more to the left. So where do you think this line is? Where do you think this circle is? What is trading? It's something to think about, okay? And ultimately, you need to come to the realization that trading is probabilistic, which means you're somewhere in between these two extremes, all right? You're not over here. A lot of people are looking for that, and it doesn't exist. I see this all the time. I have for years. People are looking for the exact perfect technical method approach that works every single time, and it will not work. It doesn't exist. All right, the nature of the environment is such that it can't work. All right, so if you're looking for that, you're going to fail. All right, you're going to lose a lot of money in the meantime. All right, and to become successful, you have to come to grips with this reality that the markets are probabilistic. And where do you think this is the question. All right, so give that some thought. I'm putting together a presentation actually that will talk about this in some more detail. But ultimately, you have to deal with the fact that we are not over here. And because we're not over here, that means there's going to be days when you lose money. There's going to be weeks when you lose money. And what are you going to do about that? You have to have a set of rules that you follow in order to survive. One analogy I like to use is the outdoor cafe owner. He can make nice money in sunny weather, but as soon as it starts to rain, he's losing money. And what he does is he sends his staff home and he just hunkers down and he weathers the storm. He's still losing money. He's still paying for his rent, his utilities, etc. He's still paying for all the food that he bought. But he's minimizing costs. All right, that's what we're doing by managing our risk. We're minimizing our costs. All right, let's see what tomorrow brings. I'm still looking for the live test of my auto ad. I almost had it here today. Had I been sitting here, this would have been just crushing as it was. I was not present, so I didn't see it fail to do what I wanted it to do. So we'll see what tomorrow brings. All right, so I don't know what's the cause of this particular overnight collapse, right? We're dealing with 100-point overnight range. All right, 100 points in the NASDAQ is just a simply enormous number. Okay. At a time of year when you normally expect things to start quieting down. All right. And if we go back to this 30-minute chart, these moves are not small. All of these are big moves the market is making. And if we look at it on like a daily chart, we can see we topped out here. All right. This is when it started, right there. Okay, this is February 2nd, right? And then this crazy volatility. And then it starts to settle down a bit. Crazy volatility again through here. Starts to settle down again. This is actually starting to look relatively normal. All right, and now we've got another, 100-point overnight move. All right. Weekly still looks okay. Doesn't look clearly something's up, right? But because normally the bars are a certain height. Now they're like anywhere from 4 to 10 times that height. All right, but the point is that what this reminds me of is that game where you stack blocks on top of each other. When the box starts to get when the tower starts to get really high, and then it starts to wobble. This is the wobbling. And eventually you keep stacking blocks, right? Eventually it just all falls apart. So it's not, this, earnings were good on this day, or the president did something foolish on that day, or that's not what's causing this. What's causing this is the instability of the tower, and any little catalyst can trip it like this. We're seeing the wobbling here is my view. And yeah, it'll eventually all come tumbling down, and that'll look really ugly. And then some equilibrium will be established, and we can start building blocks again. Start building our tower again using our blocks. Well, I think that you're confusing root cause with catalyst. So catalyst is the trigger. We talk about the hair, what the straw that broke the camel's back. You put that final straw on the camel's back and it breaks it, but it's not the final straw that did it. It's the enormous amount of straw that's already there. And it's the same thing here. It's not the whatever particular event caused the market to move like this. It's the underlying instability of the tower. So any little thing, a fly can land on your tower now and knock it down because it's so unstable. So it's been built on all this central bank intervention, and now as the world changes a bit, any little thing is gonna knock it down. All right.